Warren Buffett is sitting on $366 billion in cash, which is more cash than any other company in America holds. And for 14 straight quarters, his company, Berkshire Hathaway, has sold more stocks than it has bought, which is 3.5 years of straight selling stocks. But in their latest filing, they have changed their strategy by investing $23 billion, and most of that into one single stock. My name is Zack Bakos, and I'm a wealth management and financial planning professional. I have been investing for over 10 years, and I also grew my own portfolio into the millions. And I coached over 2,000 high-net-worth investors. So in this video, we are going to go through his entire portfolio, position by position. And as you can see, there are 5 companies that make up 72% of his entire portfolio, which makes it a quiet, concentrated bet on those 5 names. And we are going to cover them in detail. And by the end of this video, you will know 3 things. 1. Is the $366 billion cash pile that you're sitting on a warning sign about this market? 2. Which stock did they just buy with $23.5 billion? And why did they start buying after 3.5 years of just selling stocks? And 3, which is the one that I personally find the most interesting, is how does Buffett and his fund actually decide when to be aggressive in the market and when to be careful? Because there's a very specific number that he looks at, and it's actually fairly simple to understand. So I'm going to show you exactly what it's saying later in this video. The biggest position in his portfolio is actually Apple. This is a position that used to be a much larger pile previously. As you can see, they used to own 916 million shares, but they have over time in the last couple of years have sold it down to 228 million shares only, but this adds up to about 22% of his current portfolio. Now, why did they sell Apple? Overall, it was more from a risk management perspective, the decision that they have made, because that position for that Apple alone was bigger than every other position combined. So they just wanted to realize some of the profits on the position that they held for so long and diversify a little bit their investment portfolio. Overall, they are still very bullish on Apple, primarily because of how sticky the Apple ecosystem is. I am an Apple user. I have a MacBook. We all know it's hard to switch out of this ecosystem because it's smooth. It just works really well. And this is a company that just recorded a record quarter also from a revenue perspective. The revenue was up 16%. Even iPhone sales were up 22%. So financially, Apple continues to perform very well. His second position is American Express. This is a stock that he used to buy no matter how poorly the stock was performing or no matter what was happening in the world. He kept holding onto his American Express stocks, which currently adds up 17% of his portfolio. Their kind of thesis is that if you are an Amex person, you're paying about $900 a year for having this card. And they have very loyal customers where even though the fees keep increasing, they still keep using American Express. And that fee just rose 29%. In recent time, and their revenue with that has also grown quite solidly. His third biggest position is Google, and this is now 12.6% of his portfolio. Essentially, they went from 0 shares in Google about a year ago in 2025 September to over 106 million in June 2026. So they had more than 5x their holdings in a span of about 7 months in Google. And again, this was another shift in their approach because, as I mentioned, 14 consecutive quarters, they were selling the stocks that they overall held in their portfolio, including a large sell in 2024 of $75 billion in Apple. But this quarter, their approach has changed by deploying about $20 billion of net purchasing into mostly Google, actually, in this quarter. Now, what is their thesis on Google? And Buffett, in a late interview, have mentioned that, hey, I made the call. I changed my mind on this. It was a mistake on my end for not owning this stock for years and ignoring it. And now they decided to pull the trigger and start investing into it. Why? Well, Google in the last decade has been really just a money-making machine. Their businesses are growing quite rapidly. Even the search revenue is up, even though now we have AI and ChatGPT, and a lot of people are using Claude and ChatGPT for this kind of search. They remain a robust business. There's also up 82% of the quarter for the cloud revenue. So Buffett made a decision that this is the right time to start investing into Google, and we'll see how that goes. His fourth position is Coca-Cola, which is about 11% of his portfolio. It's a stock that they have been holding since 1988. Well, why? Because Everyone kind of still drinks Coca-Cola. They have been increasing their price ever since. And overall, it's a solid and robust business no matter what is happening in the world. And his fifth biggest position is a 9.2% position in Bank of America. Now, to be honest, this is something that they trimmed recently by 6%, even though their profit grew by 27%. Bank of America is currently 9% of his portfolio. So the other 28% of Warren Buffett's portfolio really is about two themes. One of them is energy, which is CVX, Chevron, and Occidental Petroleum, OXY. And the other 8% approximately is insurance companies, CB and MCO. And everything else, which is about 20 other positions of about 0.5%, are just smaller positions that I'm not going to talk about in this video because I just don't think they are big enough to meaningfully move their portfolios. One of the things that they could be thinking about this is that we have some starter positions in these companies, and when the market is more favorable to their opinion, they will start deploying the cash to scale up some of those smaller positions. But for now, this is the composition of their portfolio. There's also one more move that they made recently, which is a closing of a position, STZ, Constellation Brands. If you like beer, Corona, Modelo, then this is a company that they got into in late 2024. The stock has not performed very well, and they decided to close this position completely by now. Now, the data I'm using to give you all this information is coming from their latest filing. So this was their positioning as of 2026, June 30th. And this data was published on the 14th of August. So this is basically the latest, most up-to-date data you could get on Warren Buffett's funds portfolio and their positioning that I'm using in this video. Now, the big question everyone is wondering about Buffett is like, the market is skyrocketing. Why are you guys sitting on so much cash? I mean, 366 billion. It was almost 400 billion before they bought Google. Is an enormous amount of cash. Even if they put this into the S&P 500, they would have performed amazingly in the last few years. Well, to understand that, you need to understand how Buffett and Berkshire Hathaway make investment decisions. And for that, they have developed a framework that allows them to think in two perspectives. One, should we be now aggressively buying stocks? Or two, should we be now careful and just waiting cash and kind of see what is happening in the market? These are kind of the two stances that they are moving on, depending on what the data is telling them. What is the data that they're looking at? And this is one of the favorite tools based on what Warren Buffett is saying. They look at two pieces of data. The first one is the size of the US stock market. So essentially, what every US public company is worth, and they add all of that up. And the other one is the size of the economy, which is what the US as a whole country produces in a single year. And once they have these two pieces of data, they divide one by the other, and that creates a ratio. And this is what it looks like today, essentially comparing the US stock market value to the US GDP. And this is called the Buffett Indicator. Currently, it's showing that this is one of the most overvalued markets in history. And as you can see, it shows the historical trend line, which is what you would consider the fair valuation of the markets over a long period of time. And then you can see -1 standard deviation, which is like, it means it's cheaper compared to historical standards. And now it is +1, +2 standard deviations higher in terms of valuation, richer in valuation than compared to historical standards. And that ratio is currently sitting at about 220%, approximately 65% higher than the longer term trend line. So what they're looking at is historically, based on historical metrics, the current stock market for them seems to be too overvalued to be fully deployed in the market. And their approach could be explained very simply like that. So whenever the stock market is around fair valuation, is usually a good time for them to deploy into the market. If it's undervalued, it's a great time to be deploying into the markets. But currently, it's kind of on par with the internet bubble in terms of like how strongly the market is valued as of currently, because it's currently sitting at about 2.1 and standard deviation above the historical trend. So again, all you're doing is that they're looking at the market and they see potentially there might be better opportunities in the near future to deploy some of that cash into the market, which is valuations that are a little bit closer to fair value to them. So these are the three answers to my question. First of all, this is the portfolio structure that he has, is 5 concentrated positions. The new investment that they did was actually doubling down on their Google stock. And number 3, I also just explained how they make investment decisions in their market. And I also want them to keep in mind the cash position that they're sitting on is still earning a yield because it is invested into treasuries that are earning about 4%. And now you understand their playbook is that when markets are quite heavily extended, they usually just hold back and they're waiting to deploy that cash big when the market is actually correcting. And this is something that they used for about 16 years. They did the same thing in the year 2020, the same thing in 2008, where they just go in buying sprees when the market is significantly undervalued. And one last thing, make sure you subscribe to my channel. And I'm actually very curious to hear your opinion about this because there are some really interesting portfolios out there. Nancy Pelosi, Bill Ackman, Stanley Druckenmiller, some of the most legendary traders. Whether you like them or not, whether you're political or not, there's some gems and information in there in their portfolios to understand how they're thinking, to understand what they are holding, what they're betting on in the future. So if you're interested in me making more videos like this, please let me know below in the comments. And in the meantime, make sure you subscribe to my free newsletter at zackbakos.com to understand what are some of the trades that I am making real time, what my personal portfolio looks like in terms of structure, and to get access to additional research from me for completely free. Thanks, and make sure you subscribe.